This section we're going to talk about adjusting the accounts. Before we go into adjustments, let's take a look at the flow of accounting data. This is what we covered in the previous sessions. Remember, the flow of accounting data starts with a transaction occurring, and then the transaction is analyzed. Then we record the transaction in the journal, and periodically amounts are posted to the ledger. At the end of the period, we prepare a trial balance, which we then can use to prepare financial statements. However, if we are preparing accounts using the accrual method, we have to do a few more steps before we can prepare our financial statements. So after we prepare the trial balance, our next step is to adjust the accounts. Now, there are three types of adjustments: deferrals, depreciation, and accruals, and we're going to talk about that next. Let's first talk about what adjusting the accounts mean. Before we issue the financial statements at the end of the period, we need to adjust several accounts that are on the trial balance. There are several transactions that have not been recorded in those accounts, and that's the reason why I need to adjust the trial balance and bring it up to date. These adjustments fall into three types of categories: deferrals, depreciation, and accruals, and we'll take a look at each of them. Deferrals also fall into two categories: prepaid expenses or unearned revenue. Basically, deferrals are where a business has paid or received cash in advance. If the business has paid cash in advance, we call it a prepaid expense. If a business has received cash in advance, we call it an unearned revenue. Prepaid expenses are recorded as an asset when we pay for those expenses. However, when they're used or expired, that particular transaction never gets recorded in the books, and that is an adjustment. So the adjusting entry is the expense when we use or expire any prepaid expenses. This adjustment is done at the end of a period, and you only notice these adjustments when you prepare your initial trial balance. We'll take a look at an example because that'll help you understand this concept a little better. Okay, let's take a look at this example for prepaid expenses. On 1st of January 2012, Tony Corp paid $5,000 for supplies. On December 31st, 2012, which is their calendar year end, $1,500 of supplies were on hand. What we want to find out from here is what, if any, would be the adjusting entry for supplies. Now first, let's take a look at the transactions. There are two of them here, but the second one is not that obvious. The first one's a transaction that took place on the 1st of January 2012. Tony Corp paid $5,000 for supplies. By now, you all know your debits and credit rules, so you know that the two accounts affected by this transaction are cash and supplies, and that supplies increases, cash decreases, so you're going to credit cash and debit supplies. Now, the next thing they tell you is that $1,500 of supplies were on hand. What does that mean? You all know supplies are things like paper, pencils, pens, etc. And what the $1,500 of supplies were on hand means that when they went and looked at their supplies closet or supplies area, they found that only $1,500 of supplies were left at the end of the year. Now we know that we bought $5,000 worth of supplies on 1st of January, but by end of the year, we only had $1,500 of supplies left. That $1,500 of supplies left is the ending balance of your supplies account. So you started off with $5,000 of supplies, you ended up with $1,500 worth of supplies. What happened to the balance? During the year, those supplies got used up. But whenever somebody walked into the supply closet and picked up a ream of paper or picked up pencils, picked up pens, those did not get recorded in the books of accounting as the supplies that were used up, because there were no there was a transaction, there was somebody was actually taking things away and using them up, but there was no record of that transaction. We do not physically fill out a paper to go and take supplies from our supplies cabinet. So now, at the end of the year, you know that $3,500 worth of supplies were used up. Whenever we use up supplies, it becomes a cost of doing business, and we call that a supplies expense. So your adjusting entry, which you do at the end of the year, so your adjusting entry always takes place on December 31st, is to record your supplies expense. To record your supplies expense, what you're going to do is you're going to credit supplies 3,500, thereby bringing your ending balance to 1,500, and debiting an equal and opposite amount, which is your supplies expense. And that represents the amount of supplies that were used up during the year. That is your adjusting entry. Now, going back to our flow of accounting data, I showed you this transaction by using T accounts, which are ledger accounts. But in our flow of accounting data, before we post ledger accounts, we need to do our adjusting journal entry. So your adjusting journal entry is going to look like this. It's going to have the date, which is end of the period, end of the year, 12/31. You're going to debit supplies expense. You're going to credit supplies for 3,500. The description for your journal entry would be to record supplies used during the year. Now that is your adjusting entry, and there will be several other adjusting entries that you will do. Once all the adjusting entries are recorded in the journal, you will post them to the ledger. Remember, posting simply means copying the information from the journal to the ledger. Let's do another example for prepaid expenses. On October 1st of the current year, we paid $12,000 for 12 months' rent. On 12/31, it is your year end. The question is, what is the adjusting entry to record rent expenses? Let's first look at the transaction that took place on October 1st. We paid $12,000 for 12 months' rent. You know that the two accounts affected by this transaction are cash, because we always pay with cash. We paid $12,000, we always pay with cash, and then the other one is rent. Now the question is this a rent expense? We paid $12,000 up front for 12 months of rent, and this payment, since it's paid up front, is not a rent expense. It's what we call a prepaid expense. We paid it in advance. Rent is typically paid in advance, and you paid this $12,000 in advance. In that case, it's not a rent expense yet. We call that prepaid expenses or prepaid rent. The two accounts affected are cash and prepaid rent. Now, which account gets debited, which accounts gets credited? Prepaid rent is an asset. Any prepaid expenses are an asset because that gives us the right to use it for the 12 months, for the next 12 months. So that's an asset to the company. And you know that assets increase, so the $12,000 will be debited to prepaid rent, and cash went down, so cash will be credited. Remember, prepaid rent is considered an asset to the company. Now, let's go to the year end, which is December 31st. Have we used up any of this prepaid rent? In other words, on December 31st, when you prepare your trial balance, in your trial balance you will have prepaid rent as showing up as $12,000. Is that accurate? No, because that prepaid rent was paid on October 1st, and now it's December 31st. So how many months have we gone through? October, November, December, which is 3 months. We've used up 3 months of that 12 months prepaid rent. Since we've used up 3 months of the rent, on December 31st, what is the rent expense? How do we calculate it? Well, you know that the $12,000 that we paid was for 12 months, which means the rent is $1,000 per month. 12,000 divided by 12 months. Now, how many months have we used up? We said 3 months. So you multiply 1,000 by 3 to come up with $3,000 rent expense for the months of October, November, and December. Now let's show you your adjusting entry. I'm going to show it again in the T account format, which is a ledger. What you're going to do is you are going to debit rent expense for $3,000 and you're going to credit prepaid rent, reducing prepaid rent. Now, on December 31st, how much unused prepaid rent do you have? You have $9,000 worth of prepaid rent left as of December 31st. 12,000 minus 3,000 is $9,000. It's the balance on your prepaid rent. If you remember, the trial balance that you prepared earlier would have had $12,000, which is inaccurate. So now our adjusting entry made sure that we showed the true picture, which is we have $9,000 of unused rent as prepaid rent. Again, going back to it, remember, first you have to record the transaction in the journal. So your adjusting entry is going to go in the journal first. You're going to put the adjusting entry on December 31st, always end of the period. You're going to debit rent expenses 3,000, credit prepaid rent 3,000, and the description is to record rent expenses. Then we're going to post it to the ledger accounts. Remember, even though I show you ledger accounts up front, before we do get the numbers to the ledger accounts, we have to prepare your journal entries. So that was the first type of deferral, the prepaid expenses. And you saw that how we had to do adjusting entries at the end of the period if we had any prepaid expenses. The next type of deferral is what we called unearned revenue. Unearned revenue is when a company receives cash from customers in advance. So before they perform services or sell goods, the customer pays the company cash. When that happens, we called it an unearned revenue. And unearned revenue is a liability for the company when the payment is received. Once the company performs the service or sells the goods or delivers the goods to the customer, then we record the revenue as earned. Let's take a look at an example. On December 1st, National Geographic received $24 from a customer for a 12-month subscription for their magazine. You all know that whenever people subscribe to magazines, you have to send the entire subscription amount up front before they will send you the magazines. So this particular customer sent $24 for a 1-year subscription to a magazine, and this payment was received on December 1st. December 31st is their year end. What is the adjusting entry, if any? So basically, what we're trying to see is there an adjusting entry related to this $24 that we received from a customer? First, let's post this transaction that occurred on 12/1. On December 1st, we know that the two accounts that are affected are cash because they sent us $24 cash, and whenever we receive cash upfront from a customer, before we perform a service or sell goods, we call that unearned revenue. So it goes into an account called unearned revenue. Remember, this unearned revenue is a liability account. So your journal entry or your two accounts, what's going to get debited and credited, it's going to be cash. It's debited because cash increased by $24, and unearned revenue gets credited to the unearned revenue account. This $24 in the unearned revenue account we said was a liability, which means it's a debt to the company. It's a debt to the customer until we fulfill our debt and provide them with 12 months of magazines. That $24 remains a debt. Now, remember that this $24 was for 12 months subscription, which means 12 issues of a magazine. Now let's go to the year end, which is December 31st. How much revenue have we earned? we would have shipped the customer one issue because 1 month has passed. So we can record that revenue for one magazine that we have shipped. So how much revenue should we record? You know that $24 was for 12 months, which means each magazine is $2 of revenue. And we only had 1 month, so we are going to record 2 times 1 or $2 of revenue. The two accounts affected are revenue and unearned revenue. So you're going to credit revenue for $2 and debit unearned revenue. You're going to reduce unearned revenue by $2 and transfer it to your revenue. Now, how much debt do you have? You have $22 of debt remaining for your customer. You owe them $22 worth of magazines. Again, I showed you ledger accounts visually, but you know that before the amounts get into ledger accounts, you have to do your adjusting journal entry, which looks like this. Your adjusting journal entry will be on December 31st. Unearned revenue $2 debit, revenue $2 credit, and your description will be to record revenue earned. And then once you do that, you will be posting those amounts to your ledger. One thing to keep in mind, your adjusting entries are always, always, always done at the end of the accounting period, at the end of the month, end of the quarter, or end of the year. Adjusting entries do not get done during a period, it gets done at the end of a period. Another thing about unearned revenue, there are lots and lots of practical applications for unearned revenue. We'll talk about some of them in class, and for my online students, that's going to be probably a discussion board topic. But I'll give you one more example. All of you paid tuition fees to NCTC in August before you start your fall semester. So let's take NCTC because we always look at it from the point of view of the company. NCTC, let's say, receives $500 from a student as tuition. We collect that $500 up front. We have not provided you any services yet. We have not taught you that class yet. So that $500 that you paid before you start your classes is an unearned revenue to NCTC. When does it become earned revenue? When we do our obligation, which is teach the class and give you a grade at the end of the semester. At that time, we have earned our revenue, and then NCTC can do an adjusting entry to transfer that $500 from unearned revenue to revenue. There are lots of other practical applications for unearned revenue. I want you to think about a few. You may not realize it, but you use a lot of them every day. And we'll discuss about that in class and on a discussion forum later on.